Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Friday, March 13th, 2026. The day started with a clean relief bid, and then it flipped. Stocks opened strong, but once crude ripped back higher, the tone turned defensive into the close. Simple story: oil up, inflation fear up, and the market took risk down. By the end of the day, this wasn't panic. It was a controlled, risk-off fade. Mega-cap tech cracked, while energy and the defensives kept the tape from really breaking. On the S&P 500 Heatmap, you got that classic look where the biggest tiles told the whole story. A lot of the heaviest names were red: Apple, Microsoft, Nvidia, Meta, Broadcom, so even with some green in the corners, the session read risk-off. There was visible refuge, though. Energy was bright, and staples and utilities leaned green. And in semiconductors, Micron was the anomaly, one of the few standout green towers in an otherwise heavy group. That heat map split wasn't random. It lined up with the money flow. Leadership came from energy, utilities, and consumer staples, places that tend to work when inflation anxiety is rising and investors want stability. The laggards were the duration side of the market: technology, semiconductors, and mega-cap-weighted communication services. The tape did not reward the crowded growth complex today. Micron's strength inside a weak semi-group nailed the vibe. Not a full-on bid for the basket, more selective positioning while traders degrossed. So what tied it all together today? Crude was the macro throttle. As oil climbed, equities lost oxygen, especially the long-duration parts of the market. The S&P 500 finished lower after being up earlier, which sends a clean message. Buyers showed up, but confidence didn't stick. Defensives cushioned the downside, but they didn't provide upside horsepower, and that leaves the big tension unresolved into next week. Inflation impulse from energy versus the market's desire for multiple support heading into the Fed setup. On chatter, there wasn't a clean, verified list of market rumors in today's notes, but the tape traded like a headline-sensitive market, especially around war developments and anything that could move oil. Going into a weekend, that matters. Traders often react to fast-moving narratives first and sort the facts later. So if you're seeing claims fly about escalation or de-escalation, treat them as unconfirmed until there's official clarity, because the market is trading crude as the transmission line. Is the war about to end, or has it just entered its most lethal phase? And where is the supreme leader? We're 14 days into the second Iran war, and the fog of battle is finally lifting. Defense Secretary Pete Hegseth just dropped a bombshell, claiming Mojtaba Khamenei is wounded and disfigured after U.S. strikes. His silence isn't a strategy, it's a casualty. President Trump confirmed today that U.S. forces obliterated every military target on Kharg Island, Iran's energy crown jewel. He says he spared the oil pumps out of decency, but the message is clear. The next strike goes after the global energy economy's heart, and the market's not waiting for the next tweet. Brent Crude just settled a little over $100. With this energy war redrawing the global map in real time, the safety net is gone. Is your portfolio ready for the weekend? What happens when the world's biggest shadow banks lock the vault? And is your private credit fund actually a liquidity trap? It's Friday, March 13th, and the private credit bank run just went systemic. Morgan Stanley and Cliffwater are the latest to hit the gates. Morgan Stanley's North Haven fund just told investors they're only getting 45 cents on the dollar, strictly enforcing a 5% cap as redemptions jumped to roughly 11%. Meanwhile, Cliffwater saw about 14% of its $33 billion fund try to exit in a single window. They pushed their payout to the regulatory max of 7%, but it still wasn't enough. The math is broken. From Blue Owl to Blackstone, 5 giants are now under a synchronized lockdown. Why? Because the market's terrified that AI is melting the business models of the companies these funds lend to. When the private exit is locked, the public market pays the price. Are you liquid or are you trapped? Stay locked to Cat Eye US Markets. Meta was one of the clearest tells on the S&P Heatmap today. Meta finished down just under 4%, and it wasn't subtle. It was a heavyweight, bright red tile that amplified the risk-off feel. When a sentiment bellwether in mega-cap growth looks like that, it's tough for the broader market to keep an early rally going into the close. Broadcom was another big, loud move. Broadcom dropped just over 4% as the semiconductor complex sold off. In today's context, it looked like institutions cutting exposure to the AI hardware and infrastructure trade into macro uncertainty. And it mattered, because this wasn't small-cap noise. This was a major liquidity hub turning red, and that tends to pull the whole group's tone down with it. Micron was the exception that jumped off the screen. Micron surged a little over 5% while the broader semiconductor tape stayed heavy. That kind of divergence is a high-signal day. It points to stock-specific demand even as traders cut the basket. It doesn't mean the whole group is suddenly healthy, but it does show the market's still willing to pay up for select stories, even in a risk-off session. Apple was a big reason the indexes felt heavier than the broader breadth suggested. Apple fell a little over 2%, and with its index weight, that kind of move hits hard, especially on a day where the market tried to rally early and couldn't hold it. The takeaway wasn't about one Apple headline, it was that core megacap exposure got trimmed as the session turned defensive. Exxon was the cleanest single-stock red on today's macro linkage. Exxon gained just under 2% as crude climbed, and it drove home the point. Energy was acting like a safety trade, an inflation and geopolitical hedge, while growth took the hit. As long as oil stays the primary cross-asset driver, the market's going to keep watching moves like this for confirmation. And then there was ULTA, an idiosyncratic drop that still mattered for tone. ULTA sank more than 14% after quarterly results missed profit targets, making it the biggest S&P 500 decliner. On a day already tilted defensive, a consumer discretionary earnings shock like that adds to risk aversion. It's one more reminder the market is not pricing perfection across growth-sensitive areas right now. Looking ahead, the calendar is packed, and the market's sensitivity is already high. Monday brings the Empire State Manufacturing Index. Tuesday has pending home sales. Wednesday is the big one, PPI and core PPI, then the federal funds rate decision, the FOMC statement and projections, and the press conference. Thursday follows with unemployment claims, Philly Fed, and new home sales. No predictions here, but the setup is clear. Macro catalysts are stacked, and oil volatility tied to the Iran war is still the primary cross-asset driver. To wrap it up, this was a risk-off day, but a measured one. The market tried to rally, but crude pushing higher pulled the tape back into a defensive stance. Mega-cap tech is still the fulcrum for index direction, while energy and classic defensives remain where money's hiding. Into next week, keep it simple. Watch oil, watch the growth generals, and respect the macro calendar. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.